Warren Buffett has avoided gold for decades because it doesn't produce anything. No dividend, no earnings, no compounding, no business behind it. And judged as a business, gold fails immediately. But here's the problem. Gold is up 36% this year. Silver is up 128%. So was Buffett wrong? Or are investors using gold for something completely different from what Buffett was criticizing? Because if gold is being judged as a financial insurance rather than as a business, then Buffett's argument may still be right, but incomplete. That is what we need to look at today. Gold has dipped slightly below the $4,500 level. It's currently $4,492, down about 0.5% on the day. Silver is also softer today, currently $75.50, down 38 cents. But the year-to-date picture is still extraordinary. Gold up 36%, silver up 128%. And this is where the debate becomes interesting, because Warren Buffett's criticism of gold is not foolish. It is logical, but it may not answer the question investors are now asking. In this video, I want to look at why Buffett avoids gold, why his argument still matters, what the current gold and silver position is telling us, and why gold may still have a role if you see it as financial insurance rather than a normal investment. And silver matters here too, because if gold is the insurance argument, silver is the more volatile stress test of that argument. Part monetary metal, part industrial metal, and often much more dramatic. Welcome to the 2% Brief. If you follow gold, silver, oil, inflation, and the wider financial system, please subscribe. This is exactly what we track here. Each week in the 2% Brief Inner Circle, I set out the gold, silver, and oil levels I'm watching, the key scenarios, and what would confirm or invalidate the moves. The Substack link is in the description and pinned comments below. This is analysis and commentary, not financial advice, and always do your own research before making any financial decisions. And if you want the wider market background after this, I'll put a related video on screen at the end, looking at how gold, silver, and oil are fitting into the current market picture. Now let us start with Buffett's argument. Warren Buffett is a value investor. He likes productive assets. He likes businesses that generate cash flow. A good company can sell products, earn profits, reinvest those profits, pay dividends, buy back shares, expand operations, and grow over time. That is the engine of compounding wealth. Gold does none of that. If you buy an ounce of gold today, then years from now you will still own an ounce of gold. It has not built a factory. It has not increased earnings. It has not paid you income. It has not created a new product. So if the question is simply this, would you rather own a great business for 30 years or a bar of gold for 30 years? Buffett's answer makes sense. Over long periods, productive businesses have often been one of the strongest ways to build wealth. And anyone who owns gold should understand that. Gold is not a productive asset. It's not a business, it's not a cash flow machine, but Buffett's argument does not settle the whole debate, because gold has a different job. Gold investors are not usually buying it because they expect it to produce earnings. They're buying it because it sits outside the promise-based financial system. It's not someone else's liability. It does not depend on a company's management. It does not depend on a government's fiscal discipline. It does not depend on a central bank getting every decision right. And that is the real distinction. Buffett looks at gold and asks, what does it produce? Gold investors look at gold and ask, what does it protect me from? Those are not the same question. Think about household insurance. You do not buy home insurance because you expect it to pay a dividend. You do not get angry because your car insurance has failed to compound over 20 years. You hold insurance because if something goes wrong, you want protection. Gold plays a similar role for many investors. Not perfectly, not always, and certainly not without volatility. But the logic is different from buying a normal company. The gold investor is not saying, this metal will grow profits. They're saying, this metal may protect purchasing power if confidence in paper money weakens. And this is why Buffett's argument becomes both right and incomplete. He is right that gold does not produce cash flow. He is right that gold is not a business. He is right that productive companies can build real wealth over time. But if investors are worried about money itself, then gold is not being asked to behave like a company. It's being asked to behave like insurance. Now, look at the current market. Equities have had a strong year too, especially in the United States. So gold and silver are not rising simply because investors have abandoned shares. They're rising because something else is being priced. That concern is confidence. Confidence in money, confidence in debt, confidence in central banks, confidence in inflation coming under control without causing another problem somewhere else. Today, the dollar index is sitting at 99. Oil is lower, with Brent crude at $96.50 and WTI at $90, both down $3. Now, lower oil is good news at one level. It can ease pressure on transport costs, food distribution, manufacturing, and inflation expectations. But lower oil does not solve the deeper question. It does not tell us whether confidence in money, debt, central banks, and the wider financial system has shifted. Government debt is still high. Borrowing costs still matter. Consumer confidence still matters. And the Federal Reserve still has to deal with the risk that inflation may not return smoothly to target. So, gold dipping below $4,500 today does not automatically mean the gold argument has failed. It may simply mean the market is pausing after a very strong year. And this is where silver becomes important. Silver is not just gold's smaller cousin. It lives in two worlds at the same time. It is part monetary metal, moving on some of the same distrust signals as gold, but is also an industrial metal, used in areas such as electronics, solar panels, and wider manufacturing demand. That makes silver more volatile. It can move like a precious metal one moment and like an industrial commodity the next. And because the silver market is smaller than the gold market, price moves can be much more dramatic. That is why silver being up 128% year to date matters. It suggests the metal story has broadened beyond a quiet safe haven move. It may include monetary demand, industrial demand, retail demand, momentum, and wider concern about the value of paper claim. But that does not mean silver rises in a straight line. It clearly does not. Silver's down today. Gold's down. But the wider year-to-date picture still forces the question. If gold and silver do not produce anything, why have they performed so strongly this year? The answer may be that investors are not only buying return, they're buying resilience. And this is why I do not think investors necessarily have to choose between Buffett's productive world and the precious metals world. Strong equities can help build wealth. Gold and silver may help protect it. Those are different jobs. And it's perfectly possible for both ideas to be true at the same time. Now, if this kind of analysis helps you, join the 2% Brief Inner Circle on Substack. Paid members receive the weekly briefing, the key levels, the risk scenarios, and the follow-up analysis behind these market moves. So, is Warren Buffett still right about gold? My answer is this. Yes, if you judge gold as a business. Gold does not produce earnings, does not pay dividends, does not compound internally. On that point, Buffett is right. But maybe not if you judge gold as financial insurance. Because insurance is not supposed to behave like a business. It's supposed to be there when confidence weakens. And with gold up 36% this year, silver up 128%, oil still important, the dollar still central, and markets still wrestling with debt, inflation, and central bank policy, the case for gold cannot be dismissed simply because it does not produce cash flow. Buffett's argument is still powerful, but it may not settle the argument. Because gold is not trying to be Berkshire Hathaway. It's trying to be something outside the system. And that is the point many investors miss. The next video should appear on screen now. Watch that for the wider context because it explains how this move fits into the bigger gold, silver and oil picture. Thank you for watching. I'd appreciate it if you would give this video a thumbs up and subscribe and let me know in the comments, is Buffett wrong on gold? Yes or no?